What's up, everybody? And we're back. Welcome to another one.
Yes.
This is episode 16, guys. This is the TD Markets Academy. T.
Yep.
Always a pleasure, brother.
How's it, my man?
It's good. It's good. Sensible.
Sensible.
It's sensible.
It's all good.
And your side, how you doing?
No, I can't complain, man. Also, let me just slot it in sensible.
Sensible as well.
Sensible, yeah.
Guys, one of the advantages of being sensible is that we are able to fluctuate between the good and the bad. So you're always staying and maintaining that consistency. You know, that's why we say we are sensible.
Yes.
So, brother, episode 16.
Episode 16.
Let's push it, brother. What's on our minds here today?
Yeah. Look, I think, what's on the investors' minds?
Aha, there we
what's
go.
on the traders and investors' minds?
Yes.
All right. We're going to take it back a little bit, but we're going to take a look at where the CPI is.
Yes,
the inflation rate.
Uh-huh.
We're going to take a look at what it could do to the upcoming interest rate in the US.
Yes.
And then we're going to talk a little bit about our roadshow. Our roadshow, you know.
Yes.
We started the first leg in Emalahleni. And then we are going somewhere, but we'll just reveal it.
Somewhere, and we'll let you guys know where.
My man, No, let's jump straight into it, man. But before we do that, guys, please subscribe to our YouTube channel.
Yes.
You guys know this podcast episodes are released every Tuesdays at 6 p.m. Please subscribe, like, share, and let's get the engagement, going,
Yeah, I mean, we've really bumped up the numbers tremendously over the past several months.
We did.
And we are obviously looking to expand and grow, guys. So just to echo what T is saying, let's get that subscribe button clicked and so forth. Yeah.
Sure, 100%.
So, brother,
CPI?
Consumer Price Index. By now, the guys should know CPI is a inflationary tool, or at least measurement report.
Yeah.
Guys, that helps you engage, obviously, with what's happening with the spending in an economy. T, you want to take them a little bit more through about that CPI there?
Sure, definitely. And also, I'm going to touch on the trading room that we had. So every CPI NFP release, we have a trading room live on YouTube and Facebook. But CPI, exactly what you said, is a measurement, a unit they measure. Let me not say a unit, but the data they use to measure how to navigate around interest rates. You know, we know that inflation is one of the big factors in the US economy. We know that
any
Fed,
economy,
any economy, basically. Yeah,
but we focus. You're right. We focus on the US. Really, we do.
Definitely. So we know in the US they've got the dual mandate of maximum employment as well as price stability. The last episode we spoke about where inflation was coming from, which was 9.1%. That was around, those are the COVID levels, basically.
Yeah.
So it's been dropping. The target for the Fed is 2% inflation.
Yeah.
And right now it's sitting on 2.5%. That is the yearly inflation.
That's the year.
Right.
They've done tremendously well.
Yeah, there's been progress. Lots of progress. We also have the core CPI month on month, as well as the month-on-month CPI. But I think more than anything, Ash, I think the focus is on the yearly rate.
The yearly rate.
Yearly inflation rate. We're sitting on 2.5%.
Yeah.
When I saw that, on our calendar appearing from 2.9 to 2.5%,
That's a big drop, bro.
That's a big drop. I was excited, because I've been tracking ever since it was on 9.1%. I've been tracking it up to 2.5%.
Yeah.
And which is good news for the Fed.
Yeah.
They are closer to their targets. But then you also raised another point the last time we were here where you mentioned investors now also coming into play and all of that and looking at the interest rates as well. So now, before we get to that, 2.5 inflation. All right. We are now 2 days. Okay, now this thing will be released in Tuesday. We are recording on Monday.
Yeah.
On Wednesday, this coming Wednesday, the interest rates announcement.
Yes.
Sitting on 5.5%. All right. Now, there's a lot of opinions.
Yeah.
Some saying there's gonna be a cut of 50 basis points. Some saying 25 basis points.
Yeah.
Now, I want us to talk a little bit about that. What you think the Fed is gonna do? Are they gonna aggressively cut it? Why would they do it?
Yeah.
Factors leading to that, and if it's a 25 basis point, which I think there's a lot of sentiment around that, you know.
Yeah.
And let's just dive deep into that, just unpack it nicely.
Right?
Yeah.
So guys, just to take a step back there on the core CPI and the CPI, so just the main difference between the two there generally is the fluctuation of factors like energy and food that fluctuates a lot. That's why you have those two types of readings: the core and then the CPI. And so you want to see that from a core perspective. There's a lot of goods there that don't necessarily fluctuate that much. They stay constant. And then if you get the core, which is the one that has all of the items, now we're looking at that year-on-year one that's going to be that is so important. Now, spending, if that percentage increases, we know that that's good for a specific currency. So it should then increase in strength if that CPI goes up.
That is what the core. We're talking about the core.
Just the CPI. Okay. All right. If it does go up, there's a general increase in price. Yes.
Yeah.
Which is good because there's things happening in the economy. However, if that rate goes up consecutively, all right, and the consecutively could mean maybe 6 months, could be 4 months, could be 8 months, depending on the interpretation of inflation and the standard of living from a consumer perspective. But if that rate keeps on going up, even although it's good for the currency, it becomes like a curse.
Yeah.
Because too much of rising or spending creates a larger demand. And now suppliers, manufacturers, producers, they're seeing this demand go up here. They're like, hey, man, we can put an extra buck on our manufacturing, and that's what pushes the price up because the demand is there. And it works exactly the same as any other business.
Yep.
If your product is doing very well, and let's say you're selling it for 180 Rand, if you see the demand is coming in, you can raise it to 185.
That's of course, yeah.
It's basics business, basics to business, right?
Yeah.
But for the economy as a whole, I think that's where the focus is. If you do that for an entire nation, it has a higher impact on people's lives versus one business that is running in one community and there's no other branches, out there. There's a total difference there, right? But now, what the guys don't see here, T, is that there's two types of, I'm going to say spenders for the lack of a better word, spenders. You have the consumers. But then you mentioned now we have the investors. So each of these guys needs to get a turn to get a return on investment. Now, if inflation is high, we see consumers being the ones that's giving the seed. They will hold back because things are too high. But with that inflation going up, the Fed now understands if we don't do something, which ties back to what you said. If the Fed doesn't do something, if there's no other remedy, it means that there'll be no spending. There won't be any houses that are sold. People aren't going to buy cars. That becomes a bottleneck. So to get extra funds, they have to raise some interest rates because interest rates, that is what attracts the sharks to the blood. And so if that interest rate is raised, obviously the guys are saying, let me buy bonds. Let me see why I can invest in the country because that percentage yield is going up and I can get a higher return on investment. I hope that sums it up as an intro, at least.
Makes sense. And there's a lot of points that you touched in. So so let me put it this way. So I'm a consumer. The monthly inflation goes up, monthly CPI goes up, right? You mentioned maybe let's say 6 months consecutively goes up 6 months. So the 6th month, I'll be paying more, right? Yeah, paying more for whatever I want to buy, which I bought it 6 months ago.
6 months ago, yeah.
All right?
Yeah.
So now, then I decide, okay, look, I'm not going to spend as yet because things are up now. Maybe I need to get a second job or whatever the case is. But now, at the same time, I have credit. Maybe I've got a house, I've got a car, I've got credit cards or credit cards. So I'm still paying, right? So now, inflation is up. The Fed, they want to do something. That's why they're raising interest rates now, right?
Yes.
So now I'm not spending, but now I'm spending, you know, in a sense that if the interests are high, those credit cards, depending on is it variable or fixed interest and all of that, I'm going to be spending more.
Yes.
So even though I'm not buying something, but I'm spending more on the interest rates.
Yes.
Yeah.
Now, bro, now that's a very good point. You know why? Because now it begs the question is who then benefits from the high interest rate because consumers don't. It's the investors that benefit. But why must they benefit? Because the government needs to make money.
Of course.
So if they're not making money from consumer spending, because remember, consumer spending, they're giving money to the business. The business must pay tax. So if there's no taxes coming, because remember, inflation is high, businesses can't keep laborers, so they have to retrench because the cost of having people is too high. So you mentioned COVID 2020.
Yeah.
A lot of people were let go
Yeah.
because there just was not sustainability. People were in lockdown, etc., etc. I think the guy should be up to date with that kind of concept
Definitely.
already, right?
Definitely.
So if there's no taxes that are being paid, the government must get money somewhere. So if they can sell government bonds, as an example, a higher yield, they're still getting cash. Bonds are considered one of still the safest and most secure assets or investments that people can actually invest into, because the government will always make money. As long as we have a governmental structure and there's taxes, the government will always make money.
Always money.
So if there's bonds that they're selling, example, investors buying tens of millions of US dollars in bonds, right? And their return is, example, 5.5% on, let's say, 100 million. Because people think that people don't have that type of money. There's people that sit on hundreds of millions.
man. Yeah.
And you take your 250 million example and you buy bonds. 5.5% on that, brother. It's a lot of cash.
Yeah.
So the maturity of the bond, which is like, I'm going to say for the lack of, it's secured, right? Because there's so many opinions out there. I think I mentioned in our market review meeting this morning as well, one of our comments from Amar, our CEO, said that there's a lot of volatility right now, and it's opinions. So opinions create volatility, which is the truth, right?
Yeah, that's true.
So a bond being a secure asset, there's going to be someone that says, no, it's not. It's the same as property. There are people that are saying, don't buy property.
Yeah.
They are saying rent rather, and then move in that way. So everything that you get, for example, from a income perspective is pure profit. So you pay your rent for 1 year, and then you know it's paid up in one place. Everything else you bring in is pure profit. You're not paying any bank, anything. But then another guy comes and says, no, but property is a long-term investment. You have to buy property because, you know, once you have it, the next 5 years, you've paid it off, it's going to give you income. So there's always an opinion.
My man.
And so we don't get involved in the drama. We may have our personal views of what we consider as valuable assets or investments, 100%, and we should, right? But when it comes to what you and I do, it's like, let's give people, you know, different perspectives, which we do. When we do it in the classes, we give different perspectives so they can for themselves say, that works for me.
Yeah.
And so with the government now, it works for the government to sell bonds. And when that rate comes down, they know that there will be a deficit, but it's not forever.
Yeah.
Because new products are coming, evolution is coming, new industries are emerging. Eventually, there'll be some more elevated inflation. It's just, it's been going on. It's not like it's new.
Yeah.
But I think the discussion around inflation to many people that have not been involved, it's new to them.
Yeah.
What is inflation? Interest rates. I don't see how this works. Why am I doing so? It's new to them maybe, but as we know, bro, this thing has been around.
It's been around, man.
It's been around, bro.
Look, it's been around. And as you were talking about that, you spoke about feeling now, and it creates volatility. I was watching this other podcast, like I think a couple of weeks ago, and this big time investor said the same thing, that opinion and feelings creates volatility. And you know, you made a comparison between a retail trader and like a bank trader, right? Like the big boy, let's say the big boy.
The big boys.
You know, what the big boys know is that small boys, or let me say retail trader, let me say retail trader, you know.
That sounds a little
No.
We don't mean that, guys.
Yeah, we don't mean that. So retail traders react more on feeling and opinion, right?
Yeah.
Whereas these guys, they know that retail traders are gonna see that.
Yeah.
You know, and they capitalize on the opposite of that.
Yeah.
So it was just like an interesting comparison between these guys, you know, that are trading billions of dollars, millions of dollars, you know.
Yes.
That just came to mind. It was very thoughtful there.
And guys, ST is actually mentioning that, please understand, in our classes, we talk about all the market participants, being the central banks, the commercial banks. We talk about these guys and their role in this entire, you know, market as a whole. We are small boy retail traders.
Retail trader.
We cannot go against them. We don't have the capacity to do that. They have the capacity, so they run the market. But from a economic perspective, they know that it's just cyclical. They know that this is pure economics. They understand that as things develop and grow, there will be inflation. The degree of the inflation, maybe they can predict, they can't. That's variable. But they know for as long as we are in business, it will at some point go higher. And if it goes higher, there's ramifications and there's remedies that they need to put in place to bring that specific rate down again.
There we go.
And as you mentioned now, you said rightfully so, from 9%, we went to 2.9%. We're now sitting at 2.5%, which now threads through to the next question you had was, what could happen?
What could happen?
What could happen?
There's interest rates coming.
Aha.
You know, when inflation was going down, that's when the Fed decided to pause.
Yes,
You know,
I remember.
At 5.5%.
Yes.
And it's been more than a year now, more than 12 months now.
And now we ask why. Why would they pause that for so long?
Why would they pause? That's a very good question, right?
Why would they pause? And there could be answers that we have that's true here that we're discussing. It could be totally wrong. I mean, it's opinions, like you said, it's
opinions, yeah.
right?
Yeah.
But if they're pausing for that long, there's obviously a plan behind it. That's why people are like, okay, so what's that plan? Is it because perhaps they know they're going to control inflation, they're going to bring it down, and they don't want to lose the buy-in from the investors because there's two streams of income that they want to maintain. If they're getting enough funds for a very long time, they can build up capacity in capital. So if things go south, they still have...
Of course.
They still have money.
Yeah.
Because of the
they
two
need to
streams
have
of
money,
income that has come in from both investors and consumers there.
There
You
has
see
to
that?
be money there.
There has to be money, right?
Yeah.
So they avoid, example, having to print money. You see what I'm saying? So what's very, very interesting is that 5.5.
Yeah.
We spoke about this. We said that there's opinions. Last week I read there's 80% chance based on CPI. There was an 80% chance that we're going to have a rather conservative cut of 25 basis points. This morning, I read there's a 50% chance now that we're going to go for a 50 basis points.
And now, sorry to interject there. The last time we spoke, we said, obviously, we did the previous episode before the recent CPI.
Before the recent, yes.
And then we said, all right, now, at that time, CPI was on 2.9%.
Yeah.
And then we said, before the interest rate is going to be announced, that data that's going to come out of the
data,
CPI
no, I remember it.
might influence the Fed even more, you know?
Exactly. And so if it's 50 basis points, because the question is what could happen, right? So if it's an aggressive cut, then obviously, I mean, 50 basis points, that by the books, by default, a rate cut is weakness for a dollar in the eyes of the investor. So they're going to get less return on investment for what they put in because that interest rate yield comes down. But it's good for the consumer. Because now it ties in with what you said, that credit cards, insurance, cars, houses. So the property market, if that continues to come down, let's say they bring the interest rate to where the Eurozone is. I believe the Eurozone is at 3%. Somewhere around there.
Yeah.
3.28%.
It was released last week.
Yeah, about 3.28%. I know that they also cut rates last week as well. It was 25 basis points. So I believe they're about 3.28%. I stand to be correct, but around 3% somewhere.
We'll just have to check.
We'll just double check.
Yeah, we'll just double check.
So just imagine the US has to cut all the way down to 3%, bro. What? That's going to be a crazy, crazy one, which I highly doubt. Like to go to 3% from 5%. That is very aggressive, bro.
No, look, I think that could only happen if, number one, the target has been met on inflation. Let's say inflation dropped to drastic measures like maybe, let's say
2.1.
2.1. Or no. Even south of 2, right? Let's say
1.9.
Let's say 1.9 or 1.5. Let's say 1.5. That's a drastic number.
Bro, that's a drastic number.
And in that way, though, they're going to feel like they're more in control of inflation now, right? Then they're going to want to cut aggressively now. Right, because what's the use of them cutting consecutively? Yes, they want soft landing, but I think they'll be able to manage it even properly by those aggressive cuts.
Yeah.
Those
so the monthly, the weekly charts, the technical charts on the DXY is like we had about 101 points. Remember, I mentioned the last time if we're beneath 100, that looks as, or it's seen as depreciation of the currency. If it's above the 100-point mark, it's appreciation, or it's considered to being appreciating. So if we drop those interest rates aggressively, like you're saying, because of that inflation that maybe at 1.5%, that DXY by default should tank. we should push down all the way to those levels that we spoke about, 97 and 94.
Those on the FIP level, 78.6 FIP.
Yes, it was between 97 and 94. It was that zone there.
There was a range there. Yeah.
There was a range there that we had chatted about. And we said that would be the zone that we're looking for, that drop, if we had an aggressive cut, bro. You see, but now here's the flip side.
Yeah.
Here's the flip side, bro. If we follow ECB, because remember we chatted it was some time ago, man. There was a panel of the central banks. ECB was there. US was there. Bank of Japan was there. Bank of England was there. All four of them were sitting on that panel. Yeah. And they made a statement that they speak on a daily basis. So if the ECB knocked 25 basis points, shaved that off, it means there's obviously talks as to why. You know, they have the reasons why. And they don't. Okay, let me be honest, bro. Why would they tell us that?
What the reasons?
They're not necessarily going to give us all the reasons, because they don't say everything in the speeches.
Yeah, they don't. Yeah.
They give clues, and they leave the mainstream media to unravel it, almost like a mystery. And based on that unraveling, we react.
Of course.
But they don't give us the actualities, bro.
They never do.
They never do. And it goes exactly the same as if you look at it from a hierarchy perspective, right? In a business, you have top management, senior management, junior management. And so there's a hierarchy there. Top management won't tell senior management everything. They'll tell them what they need to know on a need-to-know basis because of where they're going from a vision perspective. If top management told senior management, hey, we are 100 trillion in debt. Now that goes down to senior management. Imagine the frustration. Senior management trickles down to junior management and the pressure and the kind of treatment that can arise from that, because now it's unnecessary pressure.
Of course.
And you're mistreating your employees. Now the turnover of labor becomes so high because people are feeling, listen, they're mistreating me here, they're abusing me, I'm going to leave the company. So it's like that hierarchy is intact. And so the same with the Fed. The Fed is at the top when it comes to finance, right? And what's happening in our countries, right? So they're not going to reveal everything, bro. So that 25 basis points, because I don't want to go off track, I want to try and connect everything to what we're saying.
Sure.
If the ECB shaves off 25 basis points, if the US shaves off only 25 basis points, because this is that flip side that I spoke about now, what if that 20, and you see how soft I went there for a second. I went so soft there for a second.
Sure.
If they shave off that 25 basis points,
yeah,
what if that sends the dollar into strength and not into the weakness that one would think? Because 5.5% versus 3%, bro, that's a 2% more in terms of return on investment. So that might send strength to the dollar and not weakness. What if that happens from an investor sentiment perspective? I spoke about the Euro USD and the Euro Stocks 50 in the market review meeting. Opening bell, I gave two scenarios to the guys. I said they have an inverse relationship, but they can have a positive one. And it all hinges off investor sentiment. Because by default, if the euro goes up, the stocks will come down and vice versa. But they can move together. It hinges off the investors. So if that 25 basis points is shaven, by virtue, we should do dollar up, example, and then we have the NAS and those other guys, they're coming down, right? But what if it all moves like this together instead? Because of the 25 basis points, there's no loss in the minds of the investor.
Yeah.
Because 25 basis points versus 50, come on, I mean, 25 versus 50. Just that narrative, the feelings, the opinions, they matter. Like, oh, wow, I can still get a lot of money if I invest in the US. And that's that two-stream income that I was speaking about now. The consumers are benefiting from lower prices, but the investors are also benefiting from interest rate that's not shaved that much.
There is a nice balance there.
Nice,
right?
Exactly, bro.
Consumer and investor. Yeah, that's another angle to look at it, you know.
Yes.
And also, the Bank of England is going to announce the rates also on Thursday.
Look at all of them shooting
Yeah. I'm not sure where it is right now. Interest rates in England. Maybe you can check.
I'm gonna check for
there
us.
for
Bro.
us.
I'll check for us. Yeah.
But we have the US interest rates announcement, the Bank of England as well.
Yeah. Let's quickly see here, bro. Do you maybe just want to chat a little bit about the USD JPY and the correlation that we maybe saw with the Euro USD and gold? If maybe we can chat a little bit about the guys that might be following those things, because gold hit all-time highs now from last week, but there seems to be a bit of a correction. Did you also check that out?
Well, I'm expecting a correction.
Okay.
Gold broke that resistance.
And you actually chatted about that resistance.
Yeah, look, there was a higher probability that gold is going to break that resistance.
Yeah.
Looking at the lows it keeps creating, I was also monitoring the gold and the gold to the euro. So you're talking about the gold to the dollar.
Yes.
But the gold to the euro as well. I was monitoring it and I saw there was a continuation pattern to the upside instead. There was an ascending triangle to the upside.
With the gold price there.
Yeah, with the gold to the euro price, you know. And, there was a higher probability that the gold dollar is going to break to the upside. So now all-time highs on gold. Now people are wondering, okay, what's going to happen? What's going to happen? So this is how I look at it.
Yeah.
The fact that the market broke a very strong level, right?
Yeah.
We are seeing an aggressive push to the upside. That price action on its own, it gives us the possibility of a retest, possible retest.
Yes.
Which we can get.
Yes.
But it's not guaranteed that you're gonna get it. Just that from a price action point of view, we could come back for the retest.
Yeah.
Where it is right now, I'm actually anticipating that we might go down to retest first. Which will mean now looking at USD JPY, I was looking at it from the daily time frame. It broke the previous structure to the downside.
Yes.
But the way it's going down, it is not as aggressive as it first went down to create that low.
It's systematically moving down.
Yeah, no, in a kind of like a channel.
Yes.
Right, formation.
Agreed.
So my view on that is if we go down for the retest on gold, then that channel might break slightly to the upside.
Got you.
On USD JPY.
Is it to create just another lower high there?
Lower high, exactly.
Another lower high.
A lower high, because it's extremely bearish.
Yeah, it is bearish right now.
To create the lower high and a continuation to the downside.
Yes.
And then you look at Euro USD now, where right now it's pushing to the upside.
Yeah.
Euro USD and gold, they have this. I don't really look at it in terms of correlation, but most of the time they move in the same direction.
Exactly. Agreed 100%.
So I'm anticipating that if gold retraces down to tap that support, we might see a retracement on Euro USD as well. Before continuation to the upside.
Got you.
So that is the correlation we see.
Yes. On the daily and the weekly on the Euro USD, I agree with you 100%. There was an impulse to the upside, broke a high. 90% of the time there is a correction.
Sure.
And that's what a lot of guys miss there when that correction takes place. So intraday it is moving up. What I would like to see now, if we correlate the fundamentals to what we just spoke about.
Yeah.
Now, pound dollar, euro dollar have similarities as well. They don't move the same time, but I agree with you when you say that we can't call it 100% correlation because there's other factors that also delay it a little bit.
Sure.
So the pound dollar now, interest rate from a technical angle, right? At this point, it is at 5%. That's Bank of England.
The pound, okay, 5%.
5%. It was at 5.25% previous.
5.25.
It was at 5.25. It's now at 5% flat.
There was a 25 basis point cut there.
Exactly. Right. United States 5.5. That's where it is previous. Like you said, it's been 5.5 the last for some time now. We have the Bank of Japan, which we love there, 25 basis point interest rate or 20. Look at that, 0.25.
0.25.
Very low. It's been like that.
It's been like that.
Yeah. It's one of their super strengths. They keep the interest rates very low because they are a massive exporter, and there's people that borrow in yen and then go invest it elsewhere, and when they have to pay back installments, it's much cheaper. So it's just a different diversifying kind of a strategy that people use.
I'm thinking of all the yen pairs. We saw a sharp drop.
Yeah, but now that was also due to them wanting to have a more hawkish stance. I don't know if they're going to change it, but it could be in the interest of the country if they want to strengthen the yen, because against other countries, we know the yen is pretty weak. But it's part of their super strength, where they want to stimulate the actual economy, and we've seen it has really pushed.
It is,
So it's going to be very interesting to see if this is the safe haven child, or it is the safe haven child, out of the ECB, Bank of England, and obviously the US. So it's like they've created diverse asset pools for the world. And people don't necessarily see it like it. Example, you have a company like TD.
Yeah, sure.
And we have various products that says you don't only have to trade Forex. If you are a person that's very busy and you don't have the time to be sitting in front of your PC to scalp or join us on one of our streams, trade stocks. And so it's a diversifying pool that we've given as an offering to our clients. And so we can give them stocks and they can track it for 2-3 months, and then they can cash out if they want, or keep it for 6 to 8 months, depending on how they do and what their strategy is. So it's quite similar to me. Well, for me personally, in my mind is that these central banks has given us asset pools to say that here's the safe haven child, low interest rates, and then you have one that has far more interest rates, and then you have the ones that are in between them. It gives investors options.
Oh, what you just said right now, if the guys are listening, they're going to use what you say because that's golden.
Yeah.
So you have this safe haven, with low interest rates.
Yeah.
You've got this major currency with high.
Yes.
And what came to my mind now is the USD JPY chart, where we have that aggressive drop.
Yes.
Yes, that's true when you said, the yen has been taking a knock on all of these major currencies, but now we're seeing a sharp decline.
Yes.
Now, on that point of low interest rates for this one and high interest rates, investors, they are moving to the safe haven. Definitely. You can see it on the charts as well.
Yeah. Exactly. Yeah. Until things stabilize. At the high point, how long will it stay? Because it was 5.5 for some time. But now how long will it stay at the next interest rate?
That's the question.
You see. And we don't have that information. They're not going to tell us, we want to drop example. They won't tell us we want to drop as low as 4.5%.
They're going to tell us, you are data dependent. They're going to mention all of these things, the PCE, the GDP, PPI.
Oh my word, bro.
Then I say, we are data dependent. We're going to look at the data and take it one step at a time.
Bro, listen to that. One step at a time.
One step at a time. That's what they always say. What I do is, the day after, so I watch the press conference, right? And the day after, I read the statement because they release the statement. I go through it, I read it, I try to study it, and they say the same things over and over and over and over and over again. I kid you not. I want the guys to go and verify this. Try and get the previous statement. The transcript.
The transcript,
and then get the next one that's going to come out.
Exactly.
And then try to compare them. It's going to be the same things.
Yes.
This upcoming one, because they're going to cut, maybe it might be slightly different, but it's the same things.
It's the core message.
The core is the same thing.
It remains constant.
Exactly.
And bro, you know what? That is part of the speech. Because if you keep sticking to this, for the lack of better words here, all right? Here's guys. If you stick to the script, who can penalize you?
No.
Who can penalize you? Because that's your interpretation after that. If we stick to the to the script and we say interest rates, we don't want them too low. We want them at least at a place where investors can benefit from our country. That's sticking to the script. You say that for 10 years. It's interpretation out there.
Of course.
Let's go back to opinions and feelings. Whatever you make of that, it is up to you. The only unfortunate part is that interpretation has colossal moves in the market because of the investor sentiment, bro.
Hey, man, when you're talking about speech right now, I was watching, I'm just going to, go off topic a little bit.
Go for it, bro.
I was watching the debate between Trump and Kamala Harris.
Bro, we must actually, you know what, for our viewers, we must actually dissect that one. For the guys, nah?
Yeah, we might have an episode.
Might
We're
have
gonna
an episode when we dissect it, yeah.
So there was a comment that Donald Trump made, and that's funny. He said Kamala Harris, what they do is that they eat dogs, they eat
cats.
they eat cats.
Springfield.
Yeah.
Springfield is a place. Over in Springfield. Springfield. That's the place where they eat dogs and cats.
Yes.
Did you know there was a second attempt on his life?
Really?
Yeah, there was a second attempt on his life.
No.
Yeah.
When was this?
He was on a golf course. It was it the first rally after? It was 2 months after the first attempt.
Yeah.
Another one. I can't remember the guy's name now. Something starting with the R, I think.
So is he too much of a threat that they want to execute him?
You know, brother, that's a very good question. From a policy perspective, the promises he's making.
Yeah, he's talking about low taxes.
Yeah. And that is good and bad depending on who the party is.
Of course.
And what they stand to lose and what they stand to gain. And I think it goes back to what we say, opinions. But you know what, brother? Can I just say this? Mm-hmm. Maybe more from a philosophical perspective. I think people, they get more upset with things they don't understand and they tend to act out. And yes, that is a core principle of human behavior, but we're seeing it being displayed on a global stage at a more professional level. It remains the same principle. If you don't understand something, the proclivity of people is that they're going to react in different ways. And if he's bringing promises and he's saying he wants to do this and that, it is human nature for people to disagree with him.
Of course. Yeah.
And that's what makes markets. It's the disagreement between buyers and sellers.
That's it.
That's it.
Like that.
And guys, if you can understand what me and T saying about that, it will make your trading journey so much more easier and less complex.
That's it. Just like that.
So, bro, just to quickly on ramp again, right? To
Sure.
to the interest rates, right?
Yeah.
So we said two scenarios. One, if it's a very strong cut, very aggressive cut, we could see that dollar tanking. If it's a conservative cut, there might be investor sentiment that is still for the dollar and saying, listen, we're not losing too much here. We can still invest. It's good. It's still a good soil, or it's still good soil for us to plant our seed. So we're gonna keep going, and that way, both streams then is actually growing.
I'm telling you, man, this cut is gonna open the floodgates. So I'm anticipating a 25 basis point cut because number one, I'm looking at where the data is of inflation, so they still want to monitor it first.
Yes.
So they are cutting just to make the consumers.
And we
happy
got we got 2 months left, right?
2 months left.
There's still two Fed speeches, right?
Yeah, I think 2 more to come after this one, of course.
After this one, still 2. So if we're at 2.5%, T, they can't cut. Okay, well, no, I'm being wrong. They can if they want to. But if you think about it from inflation perspective, 2.5, it dropped down. Okay, it's 2.9, 2.5. If it has to drop again the way it dropped now, and we drop another, it will be about 2% to 2.1 with the next reading. If we drop the same way we did now, last week, and we drop to 2.1, look how close we are to the mandate of 2%.
Yeah.
So here's the question. What if we have a small cut now, and then the next CPI data gets released, and then we have aggressive cut, or aggressive cut, small cut? See, we don't know. That's the thing, brother.
That's the thing. I'm trying to.
It's all opinion right now.
Exactly. Yeah.
So, hey, bro. So if anyone says, guys, if anyone says no, they're gonna do this, man, that's a flag for me, bro.
Wow.
The moment I hear someone come and say they're going to do this, if you are not a fly on that wall, or you're not friends, or you're not a colleague of Jerome Powell, or you're not an advisor, you're not in those, please stop saying based on 3 years ago, 5. It's still speculation. It doesn't matter.
And I think that's the beauty of the market and what we do, because we're trying to interpret every single day. We're trying to interpret this information. That's the beauty. That's where I find the beauty is.
Exactly, bro. It like equalizes us out, nah?
Exactly.
Irrespective of your experience, it's still speculation at the end of the day.
At the end of the day, that's it.
Speculation.
So, man, I think investors are now waiting. Everyone is waiting
for Wednesday, nah?
You're going to see Bloomberg in the day, I mean, SA time, because that side, time zones are different.
Yeah.
So during the day, SA time, you're gonna see Bloomberg. They'll just be focusing on it.
Yeah.
Come 8 p.m.
Bro, we also have in SA, we also have cuts. We also have
Cuts
interest
are
rate.
coming.
Yeah, you guys hear the MT5?
Definitely.
We also have.
Those cuts needs to come, man.
Yeah, and
Needs to come.
so it's somewhere. I'll try and find it now. Maybe we can transition into the next one in the meantime.
Yeah, no, look, those cuts in SA needs to come. People have debts,
Yep.
got credit that we need to pay. Those cuts, those
But
cuts
it's
needs
true,
to
brother.
come.
There we go. That is on Wednesday as well.
In the morning, I think.
In the
Is it in the
morning, 10 a.m. There we go.
10 a.m.
It's the inflation rate, brother,
Oh,
that's
not the
coming
interest
out. That's not
rates.
the interest rate. It's inflation rate. That's both core and then your inflation rate year on year. So,
alright.
so once that is done, then we're gonna see how much we cut, because obviously we move with what is happening. So the US cuts, the guys will generally see we also cut, or they hike, we hike.
So we are always behind.
Yeah.
We are just lagging behind.
We are lagging a little bit behind. But I suppose, from a textbook, if I can say a textbook perspective, we are the lesser. And guys will say, no, but we're not, because, again, opinion. But how economics is going and how business is going is that the US is a major trading partner.
That's true.
And so what they're doing and what we're doing, there needs to be synergy because of what it means for us from an exporting perspective,
Yeah.
So you are right when we say we're lagging a little bit, but it's good that we can see what the big boys are doing before we then actually come in there.
Definitely.
Yeah.
That's it. Makes sense. All right.
All right, that's great, man.
So man. So we're gonna keep an eye on the interest rates.
Yeah.
We'll come back in the next episode and
Yes.
maybe just
Yeah.
wrap up on that, see what the future holds.
Yes.
But I think I've got a feeling this floodgates are gonna be open.
It's
man.
gonna
The
be
cuts
open,
Are gonna, they might. I've got this feeling that they might cut and pause on the next one. But that's not what investors are anticipating from this.
Exactly.
The sentiment's a little bit different around that.
And bro, you know what? If I think, can we maybe add something there to the first two scenarios? I think we did touch on it.
Yeah.
If they cut now, they don't have to cut for the rest of the year.
Yeah.
They can wait for next year, example. I think we actually threw that in somewhere there to say, what if they cut once this year?
Yeah, exactly.
And they say, guys, we are almost there.
Yeah.
If we could, if we could keep the interest rate at 5.5 for so long, why must we put pressure on ourselves if we can see people are still spending, investors are still interested in the US? Why do we have to cut further for 2024? We can cut in 2025.
Yeah,
they can do that.
They can do that.
That's the third alternative. And that prolongs, it builds the anticipation.
Yeah.
And it adds more drama, and it becomes more dramatic for the investor because now they have to wait. It builds that anticipation.
And in essence, that's what the Fed really wants,
Anticipation.
Yeah. That drama. I mean, they've just been ever since COVID, just been drama, a movie unfolding.
So I'm actually leaning more towards that one, bro.
Is it the cut and the pause?
The cut and then the pause till next year.
Pause till next year.
Yeah, I might be wrong, but building anticipation, it could be a.
I think that will be heavily dependent on the next CPI print.
The next CPI, you think?
So if they cut now and then they pause, it will make sense. But looking at how the next CPI is going to come out, I think that will influence them even more.
Yeah.
The CPI might still go up.
Bro, and if it goes up, they might have to say, hey, guys, bro, what will shift the market? Just imagine they raise the hike, the rates.
The interest rates. Then
it will push everyone. Everyone's narrative is void.
It's void, my man.
Everyone.
Now they're going to go to safe haven, USD JPY. I'm coming to you. JPI.
Cryptocurrency, here we come.
My man.
Cryptocurrency, and TD has it.
Yeah, no, I don't know. They got the emails. They
got the emails. Yeah, just imagine that, bro. They hike those rates. People are like, hey, let's go to alternatives here.
Oh, man.
That will nullify, void everyone's speculation. And that word unexpected will be printed in that news release. The Fed unexpectedly rose the rates
Unexpectedly.
and all we have to do is say, there's nothing we can do about it. They decided that because they felt that the inflation was a bit too much, and we're going to hit December. December, there's a lot of spending.
There's a lot of spending.
There's a lot of spending. So I'm saying, hey, the guys, just brace yourselves.
Hey, that's what the drama is. That's what the drama. That's what it is.
I wish I could say it in another language. Just brace yourself. I don't know how to say that in another language.
Yeah, I think brace yourself. I think
brace yourself for a fantastic
something.
time.
Yeah, definitely. I think no. There's too many jams on the interest rates.
Yeah.
We'll see how it comes out.
And then, guys, obviously we want to chat just a little about where we're gonna be, brother. Roadshow.
Yeah, no, where we were and where we're gonna be.
Yes.
You know,
Yes.
the last time we never really touched on Witbank, but the first leg of the tour or the first stop of the roadshow, Emalahleni. Thank you so much to everyone who turned out in Witbank. It was a jump. I enjoyed myself.
Absolutely, same here.
Yeah, definitely enjoyed myself. So the next stop is Polokwane.
Polokwane.
Man, I know Polokwane is gonna come out in numbers.
Yeah. Guys, you better support. You better come out in the numbers, as T says.
Yeah.
We are looking forward to it as an academy, as TD Market as a whole. We really look forward to it, man. I mean, Emalahleni, the spirit was great.
It was great.
The guys wanted to learn. Lots of questions were asked after our masterclass, guys.
Yeah.
And we're looking forward to seeing what you guys ask as well.
And there, Ash just said it, masterclass.
Yeah.
That's what we did. So on these roadshows, we're doing masterclasses.
Yeah.
If you guys want to, there are people that are already trading in Polokwane. Some of them maybe are not. Some of them are, they don't have consistency. Whether you are an experienced trader or a beginner or you're looking for consistency, this roadshow is for you.
Yeah.
Right?
Yeah.
Of course, we're going to just drop a bit of gems there. But you're not gonna say too much in this session because you guys have to come and see what we do. All right,
exactly.
But we're doing a masterclass from 12. The guys have to be there from 12 a.m. Gonna might run up until 3. We'll see.
Yeah, midday there, guys. 12 midday.
Yeah.
Guys. Also, what myself and T is also proposing, suggesting, mentioning is that, guys, a lot of traders lack structure. There's a lot of guys, they're into strategy, and there's nothing wrong with that. I mean, we teach the guys, we define what a strategy is. We actually training people, educating people on how to create their own strategy. So we understand that there's a desire for it. We understand that there's an obsession for it. There's a love for it. Call it what you want. But a lot of guys are into strategy. We're saying, guys, let's put structure to the strategy and chat about the things around the strategy as well. All right. And that's what a lot of guys don't necessarily get to out there. And so what we are proposing, that is what the masterclass, or at least as a jewel, as a sneak preview, it's adding a bit of structure to what you already know. So whether, like T said, you're trading 2, 3 years, 4 years, 0 years, 0 months, 0 days, 0 weeks, understand we are all about structure.
Yeah.
And once you have the structure in place, you can build with that structure. And if I can add this, T, structure connects with the federal chair. They have a structured approach to their speeches. They have a structured approach on how they deal with inflation and interest rates. So what we train, we're not training you outside of the eye of the investor. We actually train you within the eyes of the investor and how they see things. And that's what makes, or at least one of the things that makes us so effective.
100%. That's it. There's nothing I can say after that, man. I think you just laid down proper. Nothing I can say. But yeah, guys, just like that, So we're hoping to see you.
Yep.
And you and you and,
and
you.
And you and you.
And you and you. In Polokwane. That is on the 28th of September. Right? 28th of September. I think now it's hot now. It's not cold. It's hot. You can just come out, bring your family, bring your friends. Tell everyone that, hey, look, there's a masterclass going on.
There's a masterclass going on. The venue, it's at the Meropa Casino. And Entertainment World. That's where the venue is from 12 p.m. Bro, you remember? I couldn't remember it now, bro, for a second. I went blank.
Yeah, no, I forgot it, but I just remembered.
Memory is great, guys.
In the Meropa, at the Meropa Casino and Entertainment World.
Yes.
That's where we will be. Come and meet us, the TD Markets team.
Yeah.
And we quite confident it's going to be a good one.
Yeah.
Polokwane never disappoints.
Yeah, they don't. So
never
guys,
disappoints.
We believe that. You should believe that. We will be there. Will you be there?
Yeah. 100%. All right.
All right, bro.
Yeah,
I think
man.
that's it. Yeah.
Yeah. Please like, share, subscribe, guys, to the YouTube. Remember, these episodes, they come out every Tuesdays at 6 p.m. Please, switch on the notification bell so you can get notified when we drop something. All right. We also have the opening bells every morning at 9 a.m. Our weekly trading rooms, Tuesdays and Thursdays at 2 p.m. We've got the CPI NFP trading room as well at 2 p.m. And yeah, guys, anything that you want, we are on our TD Markets Academy trading sessions. Of course, those are private, of course, right?
Yes.
If you guys want more details, information on that, send us an email to care@tdmarkets.com. Or check out our website,
there we go.
tdmarketsacademy.com. Fill in the form at the bottom, and let's do what you do best.
Let's do what we do best, man. Guys, from us, absolute pleasure as always. We're really happy to have you guys support us. Let's push forward. All right?
Yeah.
All right,
Great
guys.
stuff.
Have a good one.
Cheers. Have a good one, guys.
Ciao, ciao.